Good afternoon, everyone. Thank you so much for taking out time from your busy schedule on a Tuesday afternoon and joining in. We really appreciate it. Welcome to today's webinar. I'm your host, Nikhil Datta, and I'm the Growth and Marketing Lead at Xumane. With me, we have our guest, Mr. Manish Pawar, who's the Business and Product Head at Xumane. He's a chartered accountant by profession and has over 9+ years of experience designing and customizing stock option plans for various companies. He has worked with companies like Blue Dart Delivery and Farai in his illustrious career so far. Welcome, Mr. Manish.
Hi, thank you so much, Nikhil.
Yeah. So before we deep dive in to towards today's webinar, let's just talk about a few numbers because I think numbers tell a powerful story. I was also really shocked when we were doing some research about this webinar, right? And we came across some few interesting statistics. The first being that in India, over the past 4 years, people have made over $1.7 billion in wealth just by liquidating their ESOPs, right? So that's over 15,000 crores almost, right? And that too in the past 4 5 years. And all of us have seen success stories of employees from Swiggy, Zomato, right, Paytm, all of these people, senior folks, or even people at the junior level who've made like a fortune when their companies IPO'd, right? The second being that this industry is growing, right? ESOP adoption has almost doubled in the past 4 years. So in the year 2020, about 35% of funded startups were offering ESOPs to their employees, but now the number has touched to almost 68%, which is almost 2x, right? And startups are becoming more and more generous, right? So what I mean by that is that earlier the typical equity pool was about up to 10%, right, for ESOP, and now for early stage startups they are now increasing their pool to 15 to 20%, right? So there's been a huge shift, but the catch is when employees are making wealth, right, the number of ESOP pool is increasing, right? There is a lot of taxation that's also involved. So on an average, 30 to 35% of the gains that an employee makes through ESOPs is taxed, right? And only in the year 22-23, about 3,000 crore of tax related to ESOP was recovered by the government of India, right? So what all of these trends largely highlight is that ESOPs are becoming a core part of the compensation today, right? So most employees, when they're joining companies, they're also talking about, what is the equity ESOPs apart from the fixed and the variable that was always existing, right? And it has become very important for everybody, like both for employees and employers, to manage equity well, right? So that's what we're here for, right? So we will talk about everything from scratch, right? Answer all your burning questions that you might have across about anything related to ESOPs in general. So with some context and some interesting numbers, let's just get started. So Manish, let's start with the basics, right? So we have a bunch of stock option plans that are available in the market today, right? And not every plan is equal, right? So what are the different types of plans that employers can offer to their employees?
Hey, thank you, Nikhil. First of all, thanks for bringing so many detailed studies and context and some numbers and how things are happening nowadays in the ESOP world or stock option world specifically, right? Coming to your question, when you talk about stock options, typically, if you talk about Indian geography or even Southeast Asian geography, ESOPs are the top of the town always, right? But if you talk about what all other options are available for the organizations and the employers, right? There are ESOP definitely, right, and then in India recently the phantom stocks are in trend, right? The SARs are there, stock appreciation right, the ESPPs are there, RSU, which is called the restricted stock units, wherein employees are directly getting stocks or shares or directly into their demat account rather than being granting ESOPs or options and then vesting and then exercising. So multiple different options in terms of or related to stock options are available. It depends like what organization wants and what field and what stage they are in, and right what typically suits in there. So if you talk about in nutshell, like there will be like in a manufacturing unit there are 1,000 factors, right? All should work together, go in hand to have a streamlined production. Similarly, in the stock options there are n number of various factors, rather than having these absolute terms, okay, ESOPs we are going with and all, right? Though we are going to talk about it definitely in times to come, in the next few minutes. But if we talk about, there will be other factors which help, and which will be the deciding factor for the organizations or the employers or the HR functions, right, to decide what we is right for us and where we'll go ahead with this.
Got it, got it. Thanks, Manish. So now a big question for founders, right? So now that you covered that there are a bunch of different stock option plans that exist in the market, like ESOPs, RSUs, trust-based, right? Phantom, like you talked about. So as a founder or as a leader in an organization, how do I decide that okay, this is the stock option plan that is right for my company, right? So if you could talk about specific use cases, okay, in this sort of scenario, probably like a phantom would be better, but in a different scenario, probably offering ESOPs would make more sense. So could you please shed some light on that?
Yes. So as I mentioned, right, initially as well during my previous answer, right, it will always depend on multiple other factors. For example, in case of a very early stage company, right, who has just started, they have just rolled on few employees, and now they are planning to roll out ESOP for their organizations and all. So ESOP will be the right choice for them, right, because they do not have that much cash available, they do not understand about that much equity and dilutions and liquidity at this point in time, right? But what about the organization which is already there, in the play or in the picture from last 5 or 6 or 7 years? They have raised multiple round of funds, and they have that kind of a dilutions available with their investors. They have that kind of understanding, and now because they are into the business, into the operational things, right? So they may go out for a phantom, they may go out for RSUs and all, right? So it will all depend on at what stage the company is in, what actually is their agenda and purpose of launching a stock option. Maybe just hiring a new or a growth employees, or maybe just retaining the existing old employees of the company, or maybe because everyone else is giving, so we also have to give it, right? So there are different factors why organizations start thinking about ESOPs at first go. So these factors cumulatively will decide, okay, whether what is right and how we should go ahead with this right approach.
Right. So, Manish, just for the benefit of our audience, could you also please explain what are phantom stocks, what are SARs,
Yeah.
right? So, so in a little bit more detail, like I'm sure a lot of us are aware about ESOPs, but phantom stocks, SARs, RSUs are a lot of these new buzzwords that are there in the market today. So, could you please, elaborate more on them?
Right. So, though if I have to explain it or define it, I may take a whole full day in talking about these terminologies and the definitions, right? But in a nutshell, if you ask about anyone, if you what is the ESOP, right? You know, there is a stock option which you give to employee on day one. It's not a equity share, but basis your plan, basis the vesting schedule, basis the condition. After meeting certain conditions or parameters, maybe tenure, maybe performance, some thing will vesting will happen, and after that, I as an employee will have a right to convert my ESOPs into equity shares, right? Similarly, at Phantom, you go with the name. What does Phantom mean, right? Phantom means like it is equivalent to ESOP in some senses or in functionality senses, but technically it is not ESOP. Why? Because in ESOP there will be a conversion of options into equity shares. So equity share will come into picture. But when you talk about Phantom, in Phantom, organization wants to make a plan or makes the plan equally as of ESOPs, but they do not want to have those kind of a compliances, give equity ultimately to employee. They are in a cash rich position, so they can give upfront cash as well after those conditions are met. So in Phantom, organization launches the same plan, but at the end of my cycle or at the end of the period or the conditions, I as an employer don't get equity of the company, but I get equivalent amount of cash of those Phantom stocks. In nutshell, like 1,000 Phantom stock or 1,000 ESOPs, the value on the date of maturity is 10 lakh rupees. So I'll get 10 lakh rupees in my bank account through form of bonus or incentive when phantoms are matured. But when ESOPs are matured, I may get a 10 lakh worth of equity in my demat account, or I may get liquidity of those 10 lakh rupees. Right? Similarly with RSUs, as the name suggests, it's restricted stock option units. So at every vesting schedule or at every grant date, as per my offer letter or as per my grant letter, at the date of grant or at the vesting dates or at the maturity date, I directly get stock units in my account. I do not get any option. I do not get any promise. Direct stock are transferred in my account, right? So this is certain basic example for the audience if they just want to highlight between what is ESOP, what is Phantom, what is RSU, and other options, right?
Right. So from what I understand, Manish, I think with companies who have some steady cash flow coming in and don't want to dilute their equity, probably offering phantom stocks makes more sense to them,
Right.
right?
I'll
Yeah.
give you an
So
example. I'll give you a quick example here, right? Last year we were working with an organization called Sterling Biotech Limited, right? So they got a huge amount of funding. There's a PE backed firm, right? So with they approached us for a stock option plan, and we just worked with them for the ESOP plan. But during the whole process, during our scope, right, we had a multiple round of discussion, and after seeing their financials, after seeing their agendas, after seeing their purpose, okay, why they're launching it, right? We recommended them like, okay, we can go ahead with the Phantom, and then they reviewed the proposal, reviewed the various scenarios, and finally they ended up launching phantom stocks because money or cash was not a real problem. They wanted to launch it because they were having a two broad agendas of retaining the old loyal employees or the high performing employees of the organization, plus they, because they were expanding into the new units or the new business dimensions, so they want to hire from the competitions or the senior level folks from the competition, right? So that is why they were thinking of ESOPs. But when they saw the whole approach, a whole scope, and the possibilities, we ended up by creating a phantom stock plan for them. So ultimately, during the course of actions, also many organizations changes their path because ESOP at the one go may sound like the best plan, but when you, as I mentioned, like there are multiple other factors. So when you evaluate, measure, and relate each of those factors together, you come to know, okay, what is best for us and what we may launch today.
right, right. So thanks, Manish. So let's move on to the ESOP journey, right? So it entails like there are a lot of compliances, etc., that are involved, right? So from setting up a pool to actually employees being able to liquidate that and actually get money into their bank accounts. Could you please help us with understanding the whole life cycle of the ESOPs, right?
Correct. So, like in life cycle, also I'll say like there are two different perspectives here. One is from the employer end, one is from the employer end. So I'll give you a complete life cycle from both the ends because in our audience there may be someone from the employer's part, someone from the employee's end, right? And they want to understand it holistically. So as and when organization decides, okay, we are going ahead with ESOP, and ESOPs is the right thing for us to launch at this point in time. So you will first create an entire ESOP scheme, right? Which will be vetted by a consultant or your advisor, whomsoever you are creating that policy, mentioning them, "Okay, this is our purpose, this is our agenda, this is what we want to achieve." Now, most of the organizations in India earlier were not even, they were not even knowing ke why we are launching it. Maybe they know why we are launching it, but no one was measuring ke whether it is a successful or not, right? After 1 year or 2 year down the line, no one even measures ke whether we were actually able to control the attrition, whether we are actually able to hire the right kind of the resource for which we have launched it, right? So creating a perfect ESOP schemes curated and customized for our organization and our future roadmaps and projection and business plan with our ESOP schemes, right? Once that is finalized, all those compliances we are going to mention and discuss in the next segment of the questions on the upcoming line, right? I assume that they will be part of our discussion today. But once that scheme is there, once scheme is like rolling it out in the organization, you create a pool. Now we'll also discuss like whether 5%, 8%, 10% pool is created. These are the mixed number available in the market. Once your pool is created, we'll definitely discuss on it on a later part. So your scheme is designed, your pool is created. Now actual picture will come into play wherein you will grant the ESOPs to the employees or to the promised employees or whom you are planning to launch it. Once ESOPs are granted, now basis your ESOP scheme, basis your grant letter and the vesting schedules which you have prepared for them, right? The vesting will happen maybe 1 year down the line, 2 year down the line, 3, 4 year down the line, annual or semi-annual, the way we have created it. After the options are vested, now vesting means the right is being created in the name of employee, right? So you give me 1,000 ESOPs on day one. That 1,000 ESOPs will get equally vested over the next 4 years. Say 250 options are getting vested on year one, two, three, and four. Now vesting means Manish Panwar got 1,000 ESOPs on 1st of January 2025, but 250 options will get vested on 1st of January 2026. So now
Right.
vesting means I have get that right so that I can now convert on 1st of January 2026. After that date, I can convert 250 ESOPs into equity shares, right? So then the vesting will happen, maybe tenure linked or performance linked, that we may discuss in the going part. Once my options are vested, then I will exercise it and convert that ESOPs into equity share. And whenever the company, if it's unlisted company, so company gives an options, maybe at the time of funding, primary or secondary, maybe at the time of going IPO or listed, right? Company gives the option to the employee so that I can liquidate whatever is the market price of my converted ESOPs. So I am able to liquidate. So in nutshell, the ESOP scheme will be created, ESOP pool will be rolled out, then ESOPs will be granted to the selected employees. Basis the policy and vesting schedules and the grant letter, options will get vested over the couple of years or 4 years or 5 years. Once options are vested, I am able to exercise or convert options into equity shares. And finally, the liquidity, which is the end game of the option plan from the employee's point of view, and also from the employee's point of view, because they have been able to create the successful wealth for their employees, right?
Right, right. So, like you mentioned, a lot of terms like granting, exercise, vesting, etc. Right. So, I would like to pick the, the initial bit which you mentioned, like vesting. Right. It's a very confusing sort of word or a jargon, I could say, for a lot of employees. Right. So, can you break down the most common vesting schedules that you've seen and why companies prefer one vesting schedule over the other?
I'll quickly come to that question, but one of our audience, Mr. Atul, has asked questions. So maybe we have, I'm just again highlighting, there is a separate 15-minute Q&A sessions we have kept in during our session. We'll start from 3:40, 45. All the Q&As we'll be taking, but a very interesting question, like we explained, phantom, RSU, and ESOPs. Question is that what is about SAR? Sorry, I missed it. So SAR means stock appreciation right. So this is a very practical plan or practical scheme, generally most prevalent in US markets or Europe markets, by which they mean, for example, there is a startup, there is your startup, Mr. Atul, that has already been valued at $1 billion. The share price is 1,000 rupees, right? Now Manish Panwar and Nikhil Datta are joining your startup as in marketing or a sales function, hypothetically. Now you are giving me 10 lakh worth of ESOPs or 20 lakh worth of ESOPs, right? So there are two thoughts here. Okay, one is like your per share value is 1,000 rupees. You give me 1,000 options, I get 10 lakh rupees worth of ESOPs. Another thought to this school is you and your existing team have already created this startup to a valuation of 1 billion, already taken the price to 1,000 rupees. So why should Manish and Nikhil get the benefit of 1,000 rupees? For that period we were not there in the company. So from the date of my joining, the price was 1,000 rupees. You grant me 1,000 options at 1,000 rupees. So now from that point, whatever the valuation or share price will increase to that point, maybe the valuation will go to $3 billion and share price will go to 3,000 rupees per share. So I am eligible to get this incremental benefit or the difference, which is from my date of joining, price was 1,000. On the date of maturity, price is 3,000. So the 2,000 rupees gap or the difference between my joining and the maturity date, that is what I have actually contributed to in the organization. So I'll get the appreciation of that increment in the share price, right? So that increment or appreciation, you can either pay off me in cash or bonus after that maturity period is over, or you can give me equity worth at 2,000 rupees or 20 lakh rupees, right? In your case. So SAR means stock appreciation right. So I'll get only the appreciation part, maybe in form of cash, maybe in form of equity, right? Sorry, Nikhil. So coming back to your question,
Right.
we discussed about vesting schedule. Now again, because the market is being like growing from last 3 4 year to multi-folds, but before that, for first 20 30 years, ESOP market was a plain vanilla. There is a ESOP scheme, there was a 5% pool, there was a vesting schedule which was 25% annual vesting for 4 years. If you pick anyone before 2020 or 2015, 90% of the vesting schedule looks like that, maybe semi-annual, maybe quarterly, right? This was the scenario. But if you're talking about today, now organizations, employer, employee, and even the advisors and consultant has become more practical. All right, it's no more theory. Okay, in theory we have seen this, so launch it like that. So options available is like plain vanilla. Okay, I give you 1,000 ESOPs, 25% annual vesting for 4 years. Cliff is 1 year. Most people are also confused why cliff 1 year. So as per SEBI in India, a mandatory cliff period is of minimum 1 year, which means from the date of grant to your first date of vesting. The minimum period should be 12 months. So if you give ESOPs or grant ESOPs on 1st of April 2025 to any employee, now before 31st March or 1st April 2026, no option will get vested. Maybe after that date or on that date, you may have 100% vesting, you may have 20, 25, whatever. But the first vesting will happen only after 12 months. So this is called the cliff period. Now coming to the various options available, like you may have a plain vanilla vesting schedule. You may have front loaded, wherein you are hiring some. Say I'm hiring for my new retail startup. I'm hiring someone from Reliance Retail or Lifestyle or Shopper Stop at a CFO or a CSO or a some say EC committee member level. I'll give them front loaded vesting, which means maybe 1 year 50% vested, second year balance 30 vested, and third year balance 20% vested, or maybe 100% vesting at first year, maybe 50-50 in first 2 years, right? There are a delayed or a backloaded vesting, wherein it's mostly applicable for the mid to junior level of workforce, wherein the organization want to roll out ESOPs to the maximum population, but the major purpose is also to hold in for the longer period. So in that case, we may give options like 10% at the year end one, 20%, 30%, 40%. So we are holding the maximum vesting portion to the later years, right? And then you can mix and match basis the requirement, basis the case. So do not go with a plain theoretical concepts, whatever has been heard of or whatever has been mentioned. Curate your vesting schedule basis a practical case to case basis and employer to employee basis, right? Because 25% annual vesting may fit in for some people. Front loaded vesting method may fit in for the top level people, which you want to mandatorily hire, right? And give upfront benefits. But for longer retention or longer retention of those key employees, you may also try to delay vesting or maybe have a longer period of vesting instead of 4 year at 5 years, or it depends on a case to case basis, right?
Right.
So now I'll tell you there are more than 10,000 different vesting schedules available, right? Which can be linked to tenure, which can be linked to performance, which can be linked to organization milestones. It can be linked to my personal milestone. So I, as a employee, when I join, say Atul Tiwari's startup or a company, they have promised me 20 lakh worth of ESOPs. So it should not be like if I stay in the company for 4 years, I'll get everything. This
Mhm.
was happening till 10 years back, 5 years back, right? Now today employer has become more practical. Okay, why Manish? Why Nikhil? I'm giving you 20 lakh worth of ESOPs, but that does not mean that you stay in the company for 4 years and you'll get it. My organization objective is this: I have to achieve my top line to 2x. I bid a positive, PAT 15% growth year on year. This is my organizational objectives. If these are achieved, then only the vesting will happen. Or these are your key KRAs or your personal OKRs, like building a new sales team, expanding into a new geography, launching a new product altogether. So if those will get achieved, then only the certain portion of the grants will get vested, right? So we have to think and curate it smartly. Okay, what is the requirement of the organization from that employee, and what is the requirement of that employee from the organization? So this should marry. The requirement should marry with each other's expectations.
Right, right. Thanks,
Yeah.
Manish. That really helps. And so let's just move on to the next segment, right? So we've touched base about a few basics, right? So now let's just get practical and let's say I'm a startup founder or probably I'm a senior executive at a growing organization, right? And I want to issue ESOPs to my employees, right? And I am a layman. I don't know how all of this works. So how does the process work? Like how, right from the thought process, how do I get rolling with ESOPs?
Thank you, Nikhil. Just give me a second. Yeah, before I take your question, I'll again go back to the Q&A part. It's an interesting question related to our previous session only. Animesh has asked, like, what is the rationale of the backloaded and front-loaded vesting? I mean, like, organization keep it 33% equally for 3 years, or they give it a backloading, like 10, 20, 30, 40, while other keeps it front-loaded, higher ratio, like just reverse it, 40, 30, 20, 10, right? In the other than tenure, what is the rationale for ratios? Yeah, other than the tenure, what is the rationale? Animation, good question. What happens? what will like you hired me at say 50 lakh of a CTC. You had some purpose of hiring me, right? Now you see, okay, this is possible, but it may take time. 3 year down the line, 2.5 year down the line. This new process, this new plan needs time to get implemented or executed, right? But you have given me 40% upfront vesting or 30%, 100% upfront vesting. My options are vested. I leave the organization in 2 years. What will you do with the new plan? I got my pie, na. I'll leave. I'll get this offer from somewhere else or a new competitor of yours. They will give me more ESOPs, more fixed plus variable. I'll go to them for to safeguard this kind of a risk. Organization keep these 10, 20, 30, 40 as well. We are giving you ESOPs. These ESOPs will be yours only. These are not getting cancelled or forfeited, but the period is holded back because we have seen, okay, within next 4 years this plan either be successful or be implemented. The results will come out. It should not be like 100% I've given you on day one. It is all vested. Now, up 12 months down the line, my debt executive or debt CXO is leaving the organization. Legally, I cannot hold him back, right? Legally, I have given him ESOPs. So he is eligible to get that vested and exercise in his name and then leave out of the organization. And there can be other reasons as well. Okay, I have a workforce which I am highly dependent upon. It's an operation heavy organization. I want all of them to be there because if some new person will join in, then we have to train them. There will be a revamp period. There will be operational efficiencies will come after a certain amount of time. So I want to give them benefit, to reward them, to recognize them through these ESOPs or stock options. But I also want to hold their employment in my organization for a longer period of time. So that's why I roll it a backloaded vesting 10, 20, 30, 40. On the other hand, if I see, okay, this is Nikhil is there for last 10 years or last 5 years, he has already contributed to the organization, which is measurable. We recognize his efforts. Now we want to reward the ESOP stock option as a loyalty bonus or maybe as a reward to his past performances, not linking it with the future. So I may give him 33% 3 years vesting or 100% at 1 year, right? I hope this has answered your query. We'll definitely discuss this in detail during the Q&A round. Nikhil, you asked like as a layman or as a startup founder, what are the
Yeah.
exact terms which we should know? So on ESOP scheme, definitely whenever you go to a consultant or advisor or you go Google it or chat GPT it, right? There will be certain policies available. You draft a policy, you share the requirements, the policy will get drafted. But from a compliance end, there are two, three, four actions which are same for all sort of organization, whether young stage, early stage, or a unicorn startup. You have to create a ESOP scheme. You have to draft a ESOP scheme, basis your purpose, basis your requirement, basis your agenda, right? And once you create that ESOP scheme, that should definitely match with your existing requirements, expectations, the success matrices, what you want to achieve after rolling out ESOPs. Now you have to take the board approval on that draft ESOP scheme, go to board, take approval, inform board like we are creating this kind of a ESOP. This is the pool which we are creating, and go to your shareholder for approving this draft scheme. Like anything which is impacting equity, anything which is changing your equity structure in the organization, you have to go and take shareholders approval because shareholders are interested for their equity, right? There will be a dilution. So a 5%, 8%, 4% of ESOP pool will definitely dilute their equity. So you have to take a shareholders approval, board approval, approve the policy, right? Your policy becomes live. Now you are good to go or good to start granting ESOPs to the employees. Within 30 days of that approval, you have to file a form MGT 14 on the ROC portal. It's all compliances. So your existing CS team or consultants who are doing this ROC filing for you, they will do it. Plus whatever requirements, whatever filing related information data is required, is all available through the ESOP scheme as well, right? So technically or from a compliance point, all those actions are same, all those steps are same, whether you are launching for 10 employees, whether you are launching it for 1,000 employees, right? But functionally, as I keep on mentioning, there are ultimate n number of factors which the organization, the employer, the founder need to very smartly curate it because ESOP scheme is like a constitution. You have created it. Now you will follow and you will go with their guidelines and with those clauses, right? Even if you have to make a change, you have to again come to the board, take their approval, do the amendment in the existing policy and do it. And that is why in our experience, like past 2 3 years we have created more than 120 25 ESOP schemes, right? Every time we have requested or suggested or recommended, create a flexible policy, keep all the doors open, right? Because today we are coming or launching this plan from a plan A or from a plan A mindset, right? Tomorrow, after 1 year 2 year down the line, we may have a different thoughts, we may have different people whom we are going to hire, whom we want to retain. At that time, changing a certain clause which is currently not flexible will keep you doing the same exercise again, right? So create that ESOP scheme smartly, do all these compliances, and your policy is live. Now smartly think how to allocate the ESOPs, whom you are promising it. Don't make it very closed one, make it transparent and open, but at the same time, don't roll out ESOP for everyone. Then what is the premium? You have to always divide the workforce into two parts, right? As per there can be different thoughts. Major HR functions, HR leaders are available in this forum as well. Like there can be definitely two different thoughts, but in our opinion or our experience, when you give ESOPs to 100% of the organization, now what is the premium for the hardworking or the old employees or the impactful employees when you have given it for all? So you gradually start giving in to 10, then 20% of the workforce, then 30% of the workforce, and slowly you make it a practice. Okay, we'll create some policy. Anyone who completes 5 year in the organization will give them ESOPs. Anyone who completes 10 year, anyone who has got rating of 5 or top rating for consecutively 2 years or 3 years will give them ESOPs. So it's a part of your internal policies, right?
Right. Right. Thanks, Manish. So a lot of companies, like you mentioned, okay, the first step is, getting all the compliances right, having like a policy in place, right? And the second step is when you actually start granting ESOPs to your employees, right? So a lot of companies do all of this manually on an Excel. Let's say I have just five equity holders or ESOP holders in my company, right? And I think that probably spending money on a platform, doesn't make sense at the moment, right? So, in your opinion, is this sustainable, or do you think having a platform, is a better option in the long term?
Yeah, it's a very tricky question, right? From this sitting at that another side of a bench, the answer can be different. Sitting on that side of the bench, the answer can be different. But if you talk about things like I have seen organization who managed equity or ESOPs in Excel or spreadsheet for even 3,000 employees, because they had that kind of a resource, they had that kind of a team who were managing it from day one. So they were just scaling it on Excel. I've seen organization where only five people are there, four ESOP holders, but they are using a platform from day one, right? The requirements, the purpose, the understanding can be different for a different function, and also it depends like whether all in all function things are getting managed by a single function or there are multiple functions involved. Like as you see nowadays, a certain portion is being managed by the HR function. They have to plan it, they have to roll it out, they have to make all those communication, but the compliance part still stands with the company secretary or the finance team. So there is an interdepartment collaboration keep continuously going on. And the practical challenge which I face, right? I worked in the industry for 8 or 9 years, right? The priority for the HR function and the date on which the HR function is most busy is not same when the finance team is also most busy, right? So I in the finance team may be sitting very relaxed from 20th to 25th of the month or 25th to 30th of the month. At the same time, the HR function is not, and vice versa for different dates in a different period. So priorities, urgencies, requirements for a different individual for different functions will be always different. So if finance team needs a ultimate important data as on today because their audit is going on, because statutory audit needs to be closed, because financial need to be signed, and being maybe in HR function I am on leaves because my part maybe comp and benefits, payroll, compliances, everything has been done as part of my original planning. I have went on a leave, right? So there are n number of different factors why this collaboration gets complicated. You are managing it, there is single resource who knows in and out, but that resource need to be on say 15 days of leave due to marriage or maternity or anything else, right? And you just depend on them. Plus, for either for 5 employees or 500 employees or 5,000 employees, you have to go to each cell, each employee, calculate their LWD, date of grant, vesting, see their grant letters, calculate it, put it through a formula or through manually. Still, it is going to take time. And you do the complete exercise on say 4th of March. Again, someone asks you the same date on 15th of March. Again, you have to do the same calculation, right? Repeatedly for the 15th March, and then on 31st March you have to do it same, and then you just sit on a heap of possibilities of manual errors, outdated or absolute data. So again, I'm saying it depends what is the ultimate problem challenges at the organization. But now if you see from 2021-22 onwards, earlier by the study of one of a big four, like by 2020 only 18% of the ESOP organization were using some kind of a tool. Now 42 to 45% of the organization has opted for a digital platform to manage their ESOPs by the end of 2024 or 23, sorry. But I think now it has touched to around 50-55% easily, right? The kind of the rapid growth in the ESOP organizations, and organizations are launching ESOPs. So definitely it helps you in a lot other ways, not just by simply automating your Excels into uh, platform and doing whatever you're doing on Excel. It's go to the platform. It's not like that. Multiple functions, multiple matrices, multiple compliances, multiple reports, all available on a real-time basis. Simply logging into the system, downloading the report, doing the compliances, giving one auditor access to your auditors, whether internal or statutory. They will not come to you. They will simply access the platform and do the complete audit. Document vaults are available nowadays. So there are a lot of new features and functionality has been implemented or introduced in the market. So people are just uh, doing it with ease, with in a quick single clicks of a button, and not depending on any manual resources, right? So yes, it helps, but ultimately I will say, right, it's a call of the organizer when they feel okay, this is the right time for me. But even but whenever whatever time they are choosing it, it will definitely going to save their a lot of man hours, a lot of resource dependency, clearing all those manual errors. And whatever is whoever is responsible is the platform and its calculation, which the auditor has now also started openly welcoming nowadays.
Right. And I think, Manish, to add to it, a lot of what you covered is from an employer standpoint, right? I think if we just switch gears from an employee perspective as well, right? Probably having like a platform helps because, typically if it's just like an offer, like my ESOP grant letter is just like my offer letter, right? So every month, like probably at the date of joining, if I had received ESOPs worth 10 lakh rupees, after 2 or 3 years in the organization, how do I get to know, okay, when how many more options are vested, if I have to exercise them, what's the tax liability, right? How what has the growth been like? We have platforms like Zerodha Grow that have now come up in the past few years, and that's revolutionized how people have started investing in the stock market, right? Because everything has become real time, which earlier was very like people had to send in letters to the Bombay Stock Exchange, etc., etc., right? So I think digitization is the norm, and I think it is meant to happen.
Right.
And now that we've already started talking about it from an employee's perspective, I would also like to ask you that what is the real cost involved? Like, if as an employee I have ESOPs, right? What is the help me understand the taxation structure? Like, let's say I exercised my options today, right? What is the sort of tax that I'm liable to pay to the government?
Right. And just to add to your previous statement, right? I covered it from the employer's point. From the employer's point, you are not reaching out to your payroll, HR, or finance guy every now and then. Earlier, when I was in delivery, we had ESOPs, multiple different letters, different dates, different date of vestings. We keep on reaching out to the resource team, right? When is our vesting happening? What is the amount we need to pay? What is our liability? Which is your next question as well. Like, if I have to exercise in the next quarter, what amount I should be ready of, and then a lot of other questions. So 100 employees, 100 different questions, 10,000 questions coming to that payroll or HR or finance guy, right? Every now and then, and because it's not a direct part of their OKRs or KRA, but they have to answer it because they are responsible for that function, right? And ultimately, any organization when they launch a stock option or ESOP, they launch it for the ultimate beneficiary is the employee. And if the
Right.
employee is not very clear, not very updated, they're just in a world of a lot of confusions, a lot of mixed answers. They do not bother about it much, right? Many employees have put in their resignations or put their papers, go out for a new job without seeing what is the amount of unvested options we are leaving on table. So you have a ESOP worth rupees 10 lakh, your vested options are 1 lakh rupees, you have unvested option worth rupees 9 lakh rupees, you go and switch out a job with a 3 lakh or 4 lakh of increment because you do not know what is the value of my invested option. Maybe it is getting unlocked in next 3 months or 1 year or 1 year, 1.5 year, right? So this is also another angle to look from that platform perspective. Thanks for adding that. Now from the employees part, right? This is a myth in the industry. Yeah? Okay, ESOPs is just notional. It's always on paper, nothing actual. So it's actual. Go and check with people at Swiggy, Reserve Pay, Delivery. Like I myself was an employee of Delivery, right? There are a lot of good examples. Then because there is not of that clear awareness being created, that transparency is there. I think lack of proper, accurate and related information to the related query is not available in the market, and that is why a lot of myths are being created. Okay, okay, it's all paper money. You have to pay upfront a lot of lakh rupees, right, to exercise your options. So on day one, when I am getting ESOPs, or when to every organization and HR or employer here, right, when you are granting ESOPs to your employees, now create a ESOP town hall, do a ESOP town hall, launch it as an event, and then explain it clearly. Okay, what we are launching it for you. You can make 10 lakh rupees to 1 CR to 2 CR from this ESOP paper, right? And this is how you are going to make it. But before you make it or ultimately get liquidation, you have to pay the exercise price money, whatever is your exercise price, 10 rupees or 5 rupees per share or 1000 rupees per share. For any income you generate, you have to pay taxes. This is not a company's law, this is an income tax act, so company has not created that tax. But to clarify it, I as an employee, I get ESOP worth rupees 10 lakh rupees, for which I need to pay only 1 lakh rupee to the organization. Like 1000 ESOPs I am getting, I will pay 100 rupees per share to the company, which market price is 1000 rupees. So 900 rupees benefit company is giving to me. So that 1 lakh rupees I need to pay, I know it on day one when the options are granted to me, and I have a period of 4 year, 3 year with me. So I can easily do that kind of a saving or plan for my future cash outflow, because exercise price liability is fixed on day one. It does not change, right? Now, whatever income, though notional at the time of exercise, it will be a perquisite income, because I have generated ESOPs worth rupees 10 lakh are credited to my demat account, for which I have only paid rupees 1 lakh. So 9 lakh rupees wealth or worth of wealth has been created because I wasn't part of that organization. So that is my perquisite income, and the organization will deduct TDS, sorry, TDS on TDS on salary on that notional income, right? So explain this to your employees, aware, make them aware, ask them to keep curating your wealth. Nowadays, ESOP financing is also available, so we can definitely touch base back on it later on. So this is we know from day one. Now, when you sell it, actually, when you get the money in your bank account, you get a bank account credit of say 3000 rupees per share. So you're getting 30 lakh rupees for the share price or the ESOPs you have, for which you have paid 1 lakh rupees as exercise price money, for which you have already paid perquisite taxes. Now there will be a gain because you got a ESOP at 1000 rupees, for which you are selling at 3000 rupees. So you will be paying taxes on the increments, right? So it is all part of law. It is all income tax act was created in 1961. It's not just created 2 3 years back. So every information is available, everything is fixed. It's just we as an employer, we as a function who is managing it in our organization, it's our responsibility and duty to make every ESOP holder aware about their future possible outflows, taxes, exercise price money, net in hand. If you talk about industry average, net and net 60 to 65% of the total wealth employee make home, right? By paying taxes, excise price money, 30% of taxes is being paid. So these are the costs, but it's not upfront or surprising. Employee also need to plan smartly ki what is the right timing. As you hold some shares of Tata Motors, you bought it at 100 rupees, now that become 1000, or you bought it at 500 rupees, now that become 800. So you also time when to buy, when to sell. So do the same thing for your ESOP as well, because the kind of a wealth ESOP is having, that wealth is not is there in your demat account or grow account, right, with the listed share. So you do lot of researches, you study about Tata Motors, Tata shares, Sensex, Nifty. Every now and then you keep on asking your friends, yaar kaun sa share kharidna hai, kaun sa nahi kharidna hai. So why don't we do that kind of a research for our own ESOP, which is at least 10x or 20x of that price, whatever is being holded on our demat account, right? So it's a two-way traffic, which Organization also need to start thinking about conducting ESOP town halls every quarter, if not quarter, but then every 6 months, because organization is growing, their share price is growing, employees are being added to, new employees are being added to ESOP. So there is a lot of things. So still, I strongly believe this is the also purpose of having these kind of a webinars. If right information, right kind of awareness, right kind of a accurate and proven information and workflows are being communicated to employees and the employers and everyone associated with it at the right time, people can make a lot of good money. It's not a notional money or paper money. If it's a notional money or paper money, Razor Pay has done a buyback of 360 cr or something like that. Phone Pay has done a buyback, ESOP buyback of around 250 cr and all. In 2022, there was a total ESOP buyback of around 120 million in India, and in 2024, it was around 150 million, I think. Right, the numbers can be 10, 20 million plus or minus. So this is uh, that another angle to look the ESOP and ESOP rollout or any stock option rollout from this angle as well. I think Nikhil, we should now move ahead with the Q&A
Right.
section and invite all the audience to just load this chat box with all your queries or doubts. We'll try to respond to each and every questions in this chat hour. Even if the time does not allow, we promise you that each and every one of you will get a personalized response after this webinar is over. We'll just save all these queries or questions down the line and we'll respond to you one by one. But let's start with that. The Ronit asked a question, the pool percentage, right? Okay, what percentage should an organization set aside for creating an ESOP pool? Should it start with less and gradually increase once need arises to create a bigger pool? Also, how does liquidation happen in privately held company? Okay, okay, Rohit. So again, pool. If you go and research, typically it ranges between 5 to 8% or 10% in early stages. In established startups, it can be 5 or lower percent. And now, how to decide 5% is the right for me or not? So there are multiple other factors. Okay, what is your requirement? What audience you are covering? What is your valuation? So, for example, 5% I decide upfront. Okay, okay, I'll create a 5% of pool. Now, my valuation is 10 crore. My organization valuation is 10 crore. So, 5% pool is worth 50 lakh rupees. But employees associated with me, they are drawing a salary of 4 CR. So, what I'll do with 50 lakh worth of ESOP pool when I'm paying a salary of 4 CR? And vice versa to it, I am paying a CTC of 3 to 4 CR or 5 CR to all people whom I am planning to launch this ESOP, but my organization value is 200 crore. So for 200 crore valuation, even if I create a 5% of a pool, it will be 10 crore of ESOP pool. But I have to pay only 1 or 2 CR worth of ESOPs, right? So there are multiple factors which decides what percentage you should create. Ideally, it ranges between 3, 4 to 7, 8%. Depends on what your investors are asking to, how much to dilute, how much they are comfortable, what is your requirement currently and in future as well. Maybe currently I have only 50 people's drawing a CTC of 15 CR or say 1.5 CR annually, and I'm planning to launch it. But I also have a hiring pipeline available for another 10 people at a top level whom I know I will be giving on an average 40 to 50 lakh rupees of CTC, fixed plus ESOPs. So I'll create that pool from that angle. So there's no harm creating a higher pool at day one. Ultimately, you create 4% today and add another 4% after year one. Do all those compliances, all those paperwork again, and rather create 8% upfront, because this is only a diluted equity, right? Until unless you give actual ESOP, actual equity shares to your employee, there's no impact on the shareholding. I am a 100% owner of my company. I'll stay the 100% owner of my company until unless those ESOPs are converted to equity shares, right? So the day the ESOPs will be converted into equity shares, then only the dilution will happen. So there is no harm in adding a higher pool on day one. It gives you more flexibility, more option in uh, good promises and good hires as well, right? So how liquidation happen in a privately held companies? Yes, liquidation generally in a privately held companies, they wait till IPO. This is a very common answer. But yes, before that, whenever you are raising a new round of funding, say Series A, Series B, Series C, there can be two kind of fundings available. There can be a primary funds wherein an investor is putting into certain money in your company, purchasing new shares and adding money into the company's company, right? So at that time, some ESOPs can be traded off. There's a common route wherein certain secondary round of funding happens. Secondary means there will be no money coming into the company. Existing investor want to sell off some of their equity, and a new investor want to purchase. So it's a outside the company transaction, maybe on a higher price, lower price. At that time, a demand and supply gap can be met through ESOP. For example, Nikhil wants to enter into my startup by purchasing equity, and Manish is an existing investor want to sell off my existing equity or my holding. So I am selling 10,000 shares. Nikhil wants to purchase 12,000 shares. So these 2,000s will be met. The gap can be asked through the vested ESOPs companies, right? Or vested ESOP holders, right? This is a commonly sourced example. Other than this, you can have a buyback if the cash flow, if the balance sheet, if the norms allows. Companies generally cancel ESOPs and pay the existing market value of the ESOPs to the employee and cancel the ESOPs. So employee make money by selling shares at a time of primary or secondary funding, or also through the buyback until unless the IPO is happening.
We have a question from Suhas, uh, which is, can you talk on RSUs? I think we
Yeah.
covered
So I've
RSUs.
very briefly covered. I'll give a detailed a very. I'll record a video for you, Swaz, and I'll send it over to you, because explaining it will require certain time. But yes, in RSU we directly transfer shares to the employee's account. For example, you are promising me 1,000 RSU, which is a vesting schedule of 250 annually for next 4 years. So I'll get 250 shares in my demat account credited every year on the date of vesting, and I have to pay tax every year on 31st March for the increment in the share valuation, whether I have got it or not. But the RSUs were promised to me. So whatever is the valuation gain happening, I have to pay taxes on those increments. But a detailed note and a detailed study, I'll share it with you after the session is over. There are a lot of questions coming in.
Yeah, we have a question from Shikha which says, can we discuss on the FMV,
Yeah.
fair market value?
I'll just take one by one. I'm going with the questions, right. Ashika, FMV, like it's a fair market value, right? The total company's valuation as on a date divided by the existing equity shares, and you come and derive it FMV. There are different factors by which your valuer derive the FMV, right? Ultimately, FMV is like what is your company's wealth and how many shares you have. So your company's wealth is 100 CR, you have 1 CR shares. So your per share value or FMV is 100 rupees. So FMV means what will the company get if company is getting sold, or if company have to sell all their shares or all their assets as on today's date. So what amount the company will make. So my per share price comes as 100 rupees because my company is of 100 crore, right? So one share is equal to 100 rupees. That is FMV. Now that keeps on changing at a different dates, at a different time, based on different scenarios, different projections companies having. Generally, standardly, the FMV keeps on growing, but your exercise price keeps at the same level, and hence employees delta keeps on increasing. You have given me ESOP at a price of 100, so I got 10 lakh worth of ESOPs, but now that 100 has become 300, so my 10 lakh ESOP will become 30 lakh, right? So this is what FMV is. Another question is from Harsh. Is taxation similar for,
ESOP, Phantom, SAR, RSU, etc.
just a second. Yes. Same. No, the taxation is very much different. On ESOP, we pay taxes in two parts. One is perquisite, one is capital gain. The amount difference is a different one. Like you have given me ESOP at rupees 100 rupees exercise price. The day I exercise it, the price per share is 1,000 rupees. So I'll pay 900 rupees tax on 900 rupees gain as perquisite tax. But the day when I sell the ESOP, it may be 2,000 or 3,000 rupees per share. So on that difference, I have to pay capital gain, right? We will be sharing a detailed calculation, a detailed slide on the example of this different taxation treatments on ESOP, Phantom, and SAR. But to as of now, ESOP will be taxed twice on different amounts. I'm selling all my ESOPs at 3,000 rupees per share, but I have only paid 100 rupees to my organization. But the date on which I have exercised it, at that date, the price was 1,000 rupees. So I'll pay 1,000 minus 100. On 900 rupees, I will pay perquisite tax. On 3,000 minus 1,000, which is the difference of selling price minus FMV, I'll pay 2,000 rupees capital gain, right, to the government, because now I'm selling my personal asset. Another is like, is ESOP financing available for exercising ESOPs on what TNC? Yes, ESOP financing is now becoming more trendy, right? Earlier, organization like ICICI, Bajaj Finance, Morgan banks, they were offering ESOPs at ESOP financing with the upfront EMIs. Nowadays, like even through our network, also like we also do these kind of things wherein we offer ESOP financing to the employees, but ultimately employee need not to pay any EMI till the date they liquidate their ESOPs. So you have to pay 10 lakh rupees to exercise all your vested options. So you take a 10 lakh rupees of financing and the day when you will liquidate, maybe 2 year, 3 year down the line, once you get your money into your bank account, then you will pay back the ESOP financing part, which is principal plus interest to the date of liquidity. Right. So different mode of ESOP financing are available nowadays, which were not prevalent 5 year or 6 year back. Right. What are the best practices for structuring an ESOP buyback for unlisted companies? Yes, this is a very technical and a compliant related question. Uh, the best practices, like the best factor is you should have enough cash available in the balance sheet. The investor, as per the Companies Act, the factors like your reserve and surplus, your security premium, your other compliances should be meeting to run a buyback before you decide to go ahead, right? But even if you are planning it, start from day one. The day you start granting, start keeping certain provision in the name of ESOP buyback in your books. Okay, we are rolling out ESOP worth rupees 50 CR. Maybe not 100% of the employee, but 40% of the employee may ask for ESOP buyback. So 20 crore worth of ESOP provisioning or buyback provisioning will keep on adding 4 CR, 4 CR every year in our books. So whenever that day come, whenever books are ready as per the Companies Act, like reserve and surplus, security premium, they all looks legally compliant. When we plan that ESOP buyback, there is no direct hit on the cash and our valuation and our profitability in that particular 1 year, right? There's a long question. I'm just reading it out silently and then I'll answer. Even have Yeah, Atul, slightly I agree with your point, right? But ultimately, you have to see it from both the lenses. If this is the only case, this is not the right one, right? It's not the only scenario available. We have good examples as well. We have bad example as well. Now think employ or investors who have bought Yes Bank at 50 or 60 rupees, investors who have bought Tata Motors at 1,000 rupees. They are also not making any money today. But now think when any investor who have purchased Tata Motor share at 70 rupees, they are still making 10x or 8x of their investment, right? Similar with the organization, not all the startups, ESOPs go in vain. There are good cases, good example, right? So this is how when you are joining a company, when you accept a offer letter, you evaluate multiple other things, right? So if you are joining a right kind of a company, right startup, doing all your analysis, right, then accepting the offer letter. Maybe in your offer letter, ESOPs are promised. Maybe at the time of appraisal, you get the ESOPs. At that time, you accept it and you evaluate it by doing certain study, right? You do not, ESOPs are right of an employee, not an obligation, first of all. So it's your choice whether you have to accept it or not. Once we have accepted it, there are both the cases, both the possibilities are there in the long run of 4 or 5 years. Maybe organizations are not able to raise new round of fund. Maybe they are not able to convince the investor to have a buyback. Maybe their cash position, their P&L, the profitability, their cash flow position is not favorable to conduct a ESOP liquidity, and then employee have to wait. But we as an employee need to think organization has not promised us that they are giving us ESOPs and they will give us 1 CR rupees or 10 lakh rupees. Organization have promised us to give ESOPs, and ESOP has certain value, right? Now that ESOP will convert into equity shares and you become the shareholder of the company. Now whatever treatment is being done with other shareholder, including promoters, including investors, including founders, the same treatment is done with the employees who become shareholder with their ESOPs, right? So if company is doing good, if all those things are going positively in the organization's favor, ESOPs, people have made money. You have 100, 200,000 good examples, and at the same time we may have 100, 200, 500 different bad examples of ESOPs as well. So it's from the employees, and we have to, when we decide very smartly, okay, whether I have to join this startup or not, whether I have to agree on these terms or not. So at that time we are agreeing like, okay, we accept the ESOPs, right? So we have to take it from both the angles. ESOPs in case of day of separation. So another question from Monica. First question from the Monica was, what are the best practices for structuring an ESOP buyback? We answered. Another question is was, how do organization handle ESOPs in case of layoffs or performance-based terminations? And how can company minimize tax liability? So I'll answer first. Like, your ESOP scheme clearly mentions, okay, what will happen when the employee is no more an active employee of the company, and under all these scenarios, if he or she resigns, what will happen to their ESOPs? If he or she is being terminated with cause or without cause, in case of a death, in case of a permanent disability, in case of a resignation. So these scenarios are being specifically mentioned in the ESOP scheme. Generally, when an employee resigns as a good leaver, he goes, so their vested options remain active and they can exercise their vested option, but unvested option get cancelled at the time of layoffs or performance based termination, whether they define it termination with cause or without cause. As per their policy, they will do the treatment. So if the termination is with cause, so generally ESOPs vested are also cancelled. But if the vested options are already exercised, they will not get cancelled, right? So we have to read our ESOP policy or ESOP scheme, and that is why organization mention certain key clauses of their ESOP policy in the grant letter as well, and we recommend that as well, right? So it is specifically mentioned in the ESOP scheme. So if it's in the case of a death, so all the unvested options also become vested in the name of the legal hires. At the time for resignation, all my unvested options may become vested as per the company's policy. So, but if it's a termination with a cause or as a misconduct, so may organization have the right to cancel the vested options as well. How can company minimize tax liability for employees while ensuring ESOPs remain attractive? Yes, tax liabilities can be planned very smartly by doing these kind of a regular communication, transparency, and conducting ESOP town hall, because taxation on ESOP is being discussed in the industry from a long time now. Employer and employee should know what is the actual liability in the hand of my employee, at what price I'm giving them ESOP, right? 100 rupees, what price they will going to exercise. So the longer they wait, an organization is doing good. So today my FMB is 1000 rupees, maybe after 1 year it become 1500, after 2 year it become 2000, and then 3000. So the longer your employee will wait to exercise, the higher amount of perquisite income will be generated and a higher amount of perquisite tax will be paid. And perquisite tax is paid at 30% plus cess plus surcharge. So it's the highest tax bracket. So the early the employee exercise in a growing company is the best way of saving tax, because capital gain on long term is generally at 10 or 12%, right? Now 12% with without indexation benefit, but a 1 lakh rupees of tax exemption is there. So if employer and employee are aligned, like the organization is growing and so the FMV will increase, please start doing this practice. Early exercise save a lot of tax. People may make take home 75% of their total value instead of taking 65%, right? So early exercise save perquisite tax. And when you exercise early, so the holding period becomes greater than 24 months in the taxation laws, and you are able to save taxes, because short-term capital gain tax says are again at a 30%, but long-term capital gain tax are taxed at 12%, right? With certain benefits on the exemption and all. So this is one of a commonly prevalent practice, but the more we discuss on this, the more better answers and better planning we'll get, right? Definitely. Yeah. Animesh, I have copied your questions, right? Question, it's a long one, so I need a detailed answer and a response to it, along with certain sample-based calculation. So we'll email this to you, this working with you, right? Just wait for 2 days only. You will get this answered, because it's a personal one, right? It's includes certain figures and also I don't want to discuss it commonly here, but I you'll get the answer of it on the RSU valued at X number at a price of X. So you'll get the value. Yeah. Yes, thanks. As we have already ahead of the time, and I respect all of your times, right? You have given a time on the Tuesday afternoon, especially when it's India versus Australia semi-final going on. Thanks for your time. I'll quickly update. It's Australia 110 for a loss of 3 wickets on the 23rd over, and now you can keep watching the semi-final match as well. And I hope the questions and the queries are resolved and answered well. Still, for all the unanswered questions, we'll keep this answered. I will share you all this detail right within a day or two. I will request Nikhil if you can save all these questions so that we can answer in the name
Sure,
of respondent. Right.
sure.
Once again, thank you everyone for your time, and I hope it was a fruitful session for all of you.
Thanks, Manish, and thank you, everyone. Hope to see you in the next webinar soon. Take care. Have a lovely day. Cheers.